Back to school, everyone. So we talked about the purchase in the first hour. Before we go to the refinance section, I just wanted to share, I have videos on this. I have an 8-minute purchase video, I have an 8-minute refinance video, and I have a video of the actual class. The 8-minute videos never mention the word reverse. Okay, people automatically think, even though it's not true, that I'm signing over my house, my title, my equity, there'll be nothing left for their kids. Even though that's never been true, the idea with the 8-minute videos is to keep them neutral long enough so that they can actually get the facts to make an educated decision. Okay? If you want to shoot us an email for Kevin or I, we're more than happy to get those to you. Sometimes forwarding that on to someone, friends, family, relatives, potential client, could literally be a life-changing event for them. And the first time you see one of these closed and the impact it has on that client, it could potentially be life-changing for you as well. Now we're going to talk about the refinance side. We're going to talk about all the equity that people have developed in the last 5 years by living in our market. Literally, their home values have doubled. And so we're going to continue to talk about, retirement strategies and equity and that kind of thing. And I want to start, first of all, by just talking about a normal investment strategy, IRA or 401k. And you work, we make money, we put it into a retirement account with the idea that it's going to grow and have some kind of a return so that when we turn around and retire, we can draw that money back out and live happily ever after, right? It's a normal retirement strategy, except if we put a roof on it, people go, oh my God, I would never do that. And I'm like, just because you sleep in the asset doesn't mean you shouldn't use it. All right? Keep in mind, 75% of the total net worth of seniors in the United States, 3/4 of the total, is the equity in their house. We shouldn't be ignoring it. We should be incorporating it into a retirement strategy. As I said, I'm going to tell you the typical retirement strategy I see by default. Again, let's put that customer in a poorly paying, poorly funded annuity that they were never supposed to live long enough to get, called Social Security. Then let's turn around and put them in a home loan they'll never live long enough to pay off, called a 30-year mortgage. And then let's take their largest asset, the equity in their house, and take it off the table and ignore it. And then let's sit back and watch them go broke. Okay, this profile is out there in this country by the millions because they have no idea that there's any other strategy out there than mortgage payments till death. And in this hour, we're going to break that paradigm. It's old-fashioned, it's outdated, and it needs to be changed. So the advantages of a Hecm refinance, as I mentioned, the number one thing you don't want in retirement is a mortgage payment. So let's take somebody in their 50s and they buy a house and they put it on a 30-year loan. They put their money down and they just start paying. And then we'll put it in a normal market and the value goes up and the balance goes down and they get into a 50% to 60% equity position. We'll say they have 25 years left on their mortgage and they come and see me and I do a refinance. I pay off that loan. I eliminate the principal and interest payment and they live there happily ever after without a payment, and it is a life-changing event for them. Almost every client I talk to who has this profile says, if I didn't have a mortgage payment, I'd be golden. All right? And they don't know that there's any other option than mortgage payments till death. And they spend all their IRAs, their 401ks, and their Social Security making payments on a mortgage they'll never live long enough to pay off. When I can do a refinance, when the loan to value gets where it needs to be, and eliminate that payment, it is a life-changing event for them. They literally tell me I feel like I won the lottery when that happens. It takes an asset that isn't liquid and turns it into one that is. It's one of the options. It can provide a lifetime monthly income stream back on a monthly basis. The advantage of this loan, anything you draw out is tax-free, payment-free money. Well, that's the best kind. All right, so it enables us to monetize some of the equity in the property and plug it into a retirement strategy, and it literally changes their life. It's a great way to preserve other assets in the portfolio because we're not making mortgage payments till death. It's a great way to mitigate what we call spend down, which is spending down the other assets to make their payments. It's a great way to protect the house. As I mentioned earlier, you have a paid off house, and you get a suit, a lien, or a judgment against you, they will get their money. It's all about who gets there first. Put this loan in first position, you've protected the asset and put the remaining funds in something else they can't touch. It's a great way to help manage their longevity. Standard conversation that I have. Gee, if I'd have known I was going to live this long, I'd have taken better care of myself. Okay? The tax-free income is huge when plugged into a retirement strategy, okay? I tell people, you shouldn't be looking at this last, you should be looking at this first. Think of a Roth IRA, okay? The idea with a Roth IRA is you pay money into that investment account with after-tax dollars with the idea that any gain and growth that you have on it, when you draw it out, it's tax-free. This is the same thing. I told a lady, I said, I found a $126,000 Roth IRA for you. She's like, what are you talking about? I spent that money a long time ago. I'm like, no, you didn't. You sleep in it. Every single night. The way the IRS looks at it, you paid for your house with after-tax dollars. So anything you draw out of it is a loan. You already paid the taxes on it, and it is not a taxable event. And when you plug that into the proper retirement strategy, it is absolutely huge with the impact that it can have. It's a great way to mitigate tax consequences as well. What a great way to pay off other debts that you may have. So the idea is, on a refinance, it gives us the ability to be able to monetize equity in the property so that we can use it. This is my personal slide. A few years ago, I made the mistake of letting my wife read the real estate section of the Saturday newspaper, and shortly thereafter, I moved. Happy wife, happy life, right? And so this is my personal plan that I had at the time. So I buy the house, I put my money down, I'm in my mid-50s, and I just start making payments. I have no intention of paying any extra on the loan, and I have no intention of ever paying it off. And by the way, I'm way ahead of schedule on the program as well with what's happened the last few years. And my plan when I closed, I buy the house, I put my money down, value goes up, balance goes down. I'm going to get into my late 60s, I'm going to retire, I'm going to do my own Hecm refinance, eliminate the payment, and live there happily ever after. Well, when you're in your 50s and you know this going in, you have a plan other than mortgage payments till death. All right? And when I explain this to people, because when you're working with people in their 50s going, I don't want a 30-year loan with payments into my 80s, this is the exit strategy without dumping all this money trying to pay off the house or spending all of your assets trying to get there. All right? So this is a very viable strategy going in for people that are in their 50s or 60s to be able to buy more house for less money. And instead of dumping all this money down on my mortgage, I have it in the proper investment accounts. And they're growing, and don't have so much money in the real estate market. There is a plethora of ways you can draw the equity out of your property with this loan. I have never seen a financial problem that I couldn't fix if the equity was there to be able to take care of it. Number one is your lump sum. This is a one-shot deal. That was the whole first hour. How much money do I have to put down on a house so I don't have a payment and I can live there happily ever after? Or on a refinance, when does my equity position get to the point that I can refinance and eliminate the payment and live there happily ever after without a payment? That is your normal one-shot deal. This is Sharon. Isn't she cute? She's 77. Do you know why she's smiling? I gotta tell her my favorite saying. I said, Sharon, I promise you won't miss your mortgage payment a bit. And when I closed her loan, this is what I did for her. And she is so happy. This is her slide. I got permission to use it. And I want to go over this scenario because this is the most common scenario that I have. When I closed her loan, she's 77 years old. She only had 25 years left on her mortgage. We only had payments till we were 102. All right? Total Social Security income, $1,800 a month. Not too bad until you realize her PITI mortgage payment was $1,300. She's living on $500 a month. She's broke and scared. And this profile is out there in this country by the millions. Part of the problem when boomers refinance, what are they doing? They're trying to lower their payment as much as they can, and they start the 30 years over. I want to talk about the Social Security death penalty for just a minute. It plays into this. All right. The way Social Security works is an example. Let's say he makes $1,500 a month and she makes $1,000. They make $2,500 a month, and their mortgage payment's $1,000 a month. They can get by. The problem is when he dies, she gets his and loses hers, and is immediately in crisis. And you know, those mortgage companies are so unreasonable, they keep sending that statement every single month. A third of my clients are widows like Sharon with that profile. And I have a lot of customers take this out proactively to protect their spouse so they don't have to worry about a payment and the Social Security income loss when one of them dies. So in her case, she's single, passed away, and the house appraised in Eagle at $427,000. She owed $222,000. Her principal and interest payment was $1,000 a month. Gone. Well, when you're on $1,800 a month Social Security and you suddenly, quote, get $1,000 a month raise, because when that payment goes away, you got a raise, it is life-changing for the impact that it has. Closing costs were about $15,000. We're going to go over that in an upcoming slide. They're about double a regular loan. So when we do a refinance, we always look at how much money are we going to save, and we divide it into how much is it going to cost to get an idea of what our break even is, okay? So to give you an example, if I do a conventional refinance and I save you $200 a month in your payment and your closing costs are $3,000, your break even is 15 months, right? Well, in her case, I saved her $1,000 a month. Her closing costs were $15,000. Her break even was 15 months. It's the same. The normal break even period that I see is between 15 and 20 months. But the savings are immediate. And the nice thing on a refinance, you're just monetizing some of the equity in the property to pay the closing costs to eliminate the payment. This is the typical scenario that I work with every day. This profile is out there by the millions. And I literally gave her a choice. I said, well, you know, Sharon, you can make payments till you're 102, or you can not make payments at all. Guess what she did? So I did a refinance. I eliminated her payment, and when the math worked out, she had a line of credit left over for $24,000 that she can draw on at any time for any reason, tax-free, payment-free money. had a profound impact on her life. The number one fear of seniors in retirement is running out of money. It's not death. They can plan for when they're going to die. What you can't necessarily plan for is how long you're going to live. So I do the refinance. I eliminate $1,000 a month out of her mortgage, and I set her up with a line of credit for $24,000 that she can draw on, and she could pay her taxes and insurance with that when it comes due, and she actually all she has to do is live there and eat and keep the lights on. It is the cheapest living arrangement for a senior you will ever find. I do this scenario sometimes 10 to 20 times a month. And if she lives in the house for another 10 years into her mid-80s and passes away, notice 4% for an appreciation rate. Fine, we have a $340,000 balance on a $630,000 house, and there's about $300,000 in equity left for the heirs. In the meantime, what did she do with the $1,000 a month mortgage payment she's not making? Best problem ever. A 10-year payment, think of a tenured professor, is a lifetime monthly income stream back. It's based on age and equity, so every one of them is a little bit different. This is a customer that we closed in Hawaii, because I swear everybody in Hawaii has a paid-off house and is broke. And their Social Security was about $1,500 a month. 70 years old, has a paid-off house. The value was $500,000. Monthly income guaranteed for life, $1,200 a month to age 150. So as long as one of them is living in the house, the income stream is guaranteed. Future home value has nothing to do with the terms of the note. So whether the market goes up, the market goes down, the funds are guaranteed in this loan and has no impact with what future home values have. So this customer was guaranteed $1,200 a month for life for as long as they live in the house. Tax-free, payment-free money. Think of a Roth IRA. Paid all this money into their home, had it paid off. Now it's paying them back. And if they live down here into their early 80s, 10 plus years, using 4% for an appreciation rate, fine. We have a $250,000 balance on a $770,000 house, and there's $500,000 in equity left for the heirs. And if the heirs don't want to sell the house, they just pay off the loan and keep it. Who doesn't want to keep the house in Hawaii, right? And if you set it up right, you can just pay it off out of other assets or move in the house and get your own loan. The key here is an exit strategy. Part of the reason this loan has a bad reputation is because the parents take it out and don't tell the kids. Well, anytime the parents have passed away and the children find out later that there's a loan on the property, it's a bad loan. I don't care what kind of loan it is. So the key here is that there's an exit strategy on the property, and ideally they pay it off or have it refinanced or sold within 6 to 12 months. But this client wants a raise. So instead of putting it on a lifetime at age 70, let's put it on 10 years. And we suck the income stream up because I'm 70, my life expectancy is 80, I want more money so I can travel and enjoy my retirement. So I set it up on a 10-year, 120-month amortization, and the income stream doubles. And instead of getting $1,200 for life, we get almost $2,400 a month for the next 10 years, and we're just utilizing more of the equity sooner. And you can put this on any term that you want. Put it on 5 years, it doubles again. So the idea is it enables us to monetize the equity in the property in an income stream to suit whatever their financial needs are. If they're running, short each month, figure out what that is and have the loan pay that to do the shortage. Very often eliminating the mortgage payment if they have one and or setting up the income stream will fix the shortage and the retirement problem because we are monetizing equity in the property so it can be used. And at the end of 10 years, if they happen to outlive it, the income stream just stops. They still get to live there. They've just used up based on the term. So the key there is try and set it up on the proper term, whatever that may be. A line of credit is my personal favorite. Everybody needs a line of credit. It's not a question of if you're going to need the money. It's just a question of when you're going to need the money. And the best time to set up a line of credit is when you don't need it. Okay? So let's set up a line of credit. The nice thing is whatever the interest rate is on the loan, they pay you in the line of credit on whatever the funds are that's available. So let's take that lady I mentioned. She has a $300,000 house. She's 70 years old and her house is paid off. And she doesn't need the money at the time. So she sets up this line of credit and she has a $127,000 line of credit and she doesn't draw it. She just leaves it in there and doesn't use it. Current interest rate on the line of credit today is 6%. Go to the bank and ask for 6, by the way, and see what you get. So she sets up this line of credit and lets it grow. Everybody familiar with the rule of 72? You divide the interest rate into the rule of 72, and that's how long it takes your money to double. So 72 divided by 6 is 12 years. So she sets this line of credit up and lets it grow. Any of you familiar with the cost of long-term care insurance? Ow, it's very expensive. And by the way, you're going to be shocked to know this. They don't want to pay the claim. I hate long-term care insurance. It's the only insurance you'll ever take out. They hope and pray you fall over dead. Because that way all those premiums you paid in, they keep. Just doesn't seem fair, all right? So instead of paying long-term care insurance, and they've got all these rules, you have to be in there for 3 months and we'll only pay for so long, it's going to cost, but it's funny, they are always ready to raise the premiums. So instead of paying long-term care insurance, let's self-insure, okay? And so let's use a conservative number and say $500 a month. $500 a month, $6,000 a year, 13 years is $80,000, and we'll say with a reasonable return, you've got $100,000 in an investment account that is liquid that you can draw on. In addition to that, you set up this line of credit and let it grow. And you get down here into your early 80s and you start needing some in-home care. You need somebody to start coming in and helping you with medication and check on you and that kind of thing. The line of credit amount doubled. So we have $250,000 in the line of credit. We have $100,000 in the investment account, and we have $350,000 in long-term care money that we can draw on if we should need it. And we fall over dead. Well, guess who gets the $100,000? Your heirs. And they got more money, not less, because you self-insured. But let's say you do live a long and happy life and you do start to need some help and you have $250,000 in this fund and $100,000 in the investment account. You can call up and turn the money in your line of credit available into any income stream you want. Let's say it's $3,000 a month to start. So you call up the servicer and say, I want $3,000 a month deposited into my account until one of us runs out. Tax-free, payment-free money. And that money will get wired into the account every single month, just like their Social Security. And it enables them to stay in the house longer. The cheapest situation for a senior to live in is their current home without a payment. My father's only 88, assisted living, $4,000, $5,000, $6,000, $7,000 a month. I had him in an apartment for the last 2 years at under $2,000 a month. Was he better off? Of course he was. In your home, you have to pay your taxes and insurance and keep the lights on. $500, $600, $700 a month. It is the cheapest thing for them to do to stay, and the vast majority of seniors want to stay in their house as long as they can. And they're the healthiest in their home. Unfortunately, I read something that says the typical person, when they go into assisted living, lasts about 18 months. 18 to 24 months. I mean, I hate to say it, it's literally the checkout counter. And they will live much longer and be much happier if they are able to stay in their home. And this loan enables to do that. And people are thinking, oh my gosh, I'm risking my house taking this out. It's actually just the opposite. It will enable them to stay in the property much longer. So you set this up and you let it grow, and you have $250,000 in the line of credit, you have $100,000 in the other account, and you have $350,000 that you can draw on. You draw on it as long as you need to, and you pass away, and the remaining equity in the property and the money in the account goes to the heirs, and they will get more money, not less. It's a great way to self-insure. A couple of other caveats on the line of credit. The growth is indefinite as long as you live in the house. Okay? There is no end to it until you move out or pass away. So let's set up this line of credit and let it grow. Let's say we get to age 85 right here, and we have $300,000 in our line of credit. And we have a market collapse and the house is only worth $200,000. And there's $100,000 more in the line of credit than the value of the house. After 2008, I had D11s call me up and they said, we know you're a perfect client, great credit, regular income, and we don't care. We are no longer comfortable with your equity position, and they closed my line of credit. I'm almost over it. Almost over it. Future home value has nothing to do with the terms of the note. So this person gets into their mid-80s, they have a $300,000 line of credit on a $200,000 house, okay? What are they going to do? So I want to talk about my son Noah for just a minute. My son Noah, when he was growing up, when he was a teenager, we must have done a really good job raising him because he knows absolutely everything. All right? And Noah's like, well, I don't want your house. And I'm like, good. I didn't want you to have it. But you know what Noah's really good at? Cashing my checks. He's perfect. I've never had him not cash one of my checks yet. So here's what I'm going to do. He doesn't want my house. It's upside down, $100,000. There's a $300,000 on the line of credit. It's only worth $200,000, and he doesn't want my house, and I'm diagnosed with terminal illness, and I'm going to die in 90 days. What do I do for Noah? Cut him a check. So I write Noah a check as his inheritance. It's tax-free, payment-free to me, and it's tax-free, payment-free to him, and he got more money out of my estate, not less, because I set up the home equity conversion mortgage and let it grow. So I cut him a check. He's certainly a happy man, and I pass away. And down here, there's $300,000 on the line of credit. There's 33 here. I'm just going to round it up and say, fine, now there's $350,000 owed on the house, and I've passed away. It is a non-recourse loan, which means the bank, the lender, the government cannot go after the heirs, the estate, or any of their assets. They cannot go after anybody or anything, and the FHA mortgage insurance on the loan pays the difference. It's short sale insurance. So nobody has to worry by enabling the non-recourse feature. So I've passed away. I've gifted him the $300,000. There's $350,000 owed on the house. It's only worth $200,000. But knowing my son Noah, he'll change his mind after I've died and decide that he wants my house, which he can now buy for 95% of current appraised value. FHA always enables the heirs to have the property. If there's equity in the property, they just pay off the loan. If it's upside down, they can have it for 95% of current appraised value. If the house is worth $200,000, 95% of that is $190,000. He buys the house with the money I gifted him off the line of credit before I died. And he ends up with my property, and he ends up with more money. And the only people who aren't happy are the people who manage the FHA mortgage insurance pool, because they're going to pay the difference. What a great strategy to protect the heirs, help you with long-term care, and monetize an asset so you can use it when you need it. Question?
Yeah, how's the gift to him tax-free?
Well, I won't get into that too much other than ask your CPA. It's like the first $5 million. There's a huge amount out there that is not considered taxable. And that you just have a CPA involved and it's not a taxable amount, which is a great way to protect the asset and your heirs as well. Now, if I take this line of credit out and I fall over dead down here at age, we'll say 82, fine. I have a $28,000 balance on a $500,000 house. Well, even Noah can figure that one out. He'll pay the $28,000 off and just keep the house or sell it. This loan just enables options for the customer and the heirs that they otherwise wouldn't have. Closing costs. The closing costs on this loan are, we'll say, roughly about double a regular loan. And it's very interesting. I'm talking to customers and they go, God, those closing costs are so much higher than that conventional loan. I'm like, beat the payment. You want mortgage payments till death? Or no mortgage payments at all? All right, as I said, the normal break-even on them is about 15 to 20 months. The reason the closing costs are higher is the FHA mortgage insurance on the front is 2% of the value of the house. So on a $500,000 house, it's 10 grand. There's your difference. That's why the closing costs are higher. It enables and funds the non-recourse portion of the loan, so if it ever ends up upside down, the heirs don't have to worry. Remember that if you're doing a purchase, the seller can't pay any of the buyer's closing costs, and don't forget it's potentially that there could be 2 appraisals required.
But the closing costs can be
on a refi. So just think of the mortgage insurance as short sale insurance. If it ends up upside down, value versus balance, either due to amortization, what you've borrowed, nobody has to worry because the mortgage insurance will make the lender and the government whole. Underwriting. As I mentioned, it's surprisingly easy to qualify for a loan that doesn't have a payment, okay? So we don't have a debt ratio. Think residual income, think VA, all right? So for a single individual, we need $600 left over. For a married couple, $1,100. So let's underwrite a file real quick. So let's say it's a single individual and they live in a 2,000 square foot house. We're going to charge 14 cents a square foot on paper to have them live there. Take care of utilities and that kind of thing. So 14 cents a square foot on a 2,000 square foot house is $280. Let's say the taxes and insurance are $320. So the total there is $600 and they have no other debt. Add $600 to it, I need to show $1,200 in income to qualify. Done. If it's a married couple, $600 plus 11, I need to show $1,700 a month in income. You go to the bank as a single individual making $1,200 a month Social Security, and they make you a loan. Do you know what we call it in my world? Predatory lending. Because you're going to take their house. Because they're not going to, at some point, they're not going to be able to make the payment. Well, on this loan, you don't have a payment. You got to pay your property taxes, your homeowner's insurance, and live in the house 6 months and 1 day. It is the most lenient loan in the world. After 2008, this loan had a 10% default rate. I'm like, how do you have a 10% default rate on a loan without a payment? They didn't have the money to pay their property taxes. Remember, you have to pay your property taxes, your homeowner's insurance, and live in the house 6 months and 1 day. They didn't used to underwrite these. It was literally just age and equity, and they closed them, and they didn't have enough money. So we now have to underwrite them to make sure that they have enough money to pay their taxes and insurance and able to stay. And that's the whole idea behind the underwrite. And when we're underwriting, we just look back the last 24 months and we look at how they pay their property taxes, their homeowner's insurance, and their HOA if they have one. All right. And I had a customer last year, his HOA was $65 a year. It wasn't important to him and he didn't pay it. Denied. You can't imagine the chewing he took from her over that particular option. And I'll talk about what we did there in just a second. So what if they don't qualify? What if he didn't pay his $65 a year HOA payment, okay? We can set up what we call a life expectancy set aside, think escrow account, out of the equity in the property. The idea is if for some reason they don't qualify because of credit, that if you don't have a payment and the loan pays your taxes and insurance, there's nothing left to default on. And so on the customer who didn't pay their HOA, we set up a life expectancy set aside and we closed the loan anyway. So let me give you an example. Let's say their taxes and insurance are $300 a month, $3,600 for the year, and their life expectancy is 10 years. That's $36,000. Out of that line of credit, we're going to carve out a life expectancy set aside, LISA for short, and it will pay their taxes and insurance when due. There's never been a cheaper living arrangement ever. They literally have to eat and keep the lights on in the property to stay there. And when I talk to people about this, they're like, so let me get this straight. You've eliminated my payment. I don't have a payment, and my equity is paying my taxes and insurance as well. As Clint Eastwood would say, go ahead, make my day. And we close them, and you can do this voluntarily. And I have people close it voluntarily because they're like, all I have to do is eat and keep the lights on and pay my utilities. The cheapest living arrangement ever for a senior, and it helps them keep their other assets liquid. So what if they don't qualify, but they've got money in the bank? Okay, so we can use those assets and create an income stream on paper to get them to pass the residual income requirement. So let's take an 80-year-old customer, life expectancy, we'll say amortized out to age 100, which is 20 years, and they've got $240,000 in retirement accounts and that kind of thing. $240,000 divided by 240 months, we're going to plug $1,000 a month into their residual income, and they will pass just like that. Done. And they might be on $500 a month Social Security or something. And this is how we get people to pass and close on this, because there's no debt ratio. It's very creative with the things that you can do. So when it comes to asset dissipation, let's say they don't have much money in the bank, but their house is close to paid off and they have a bunch of money in the line of credit, we can use the money in the line of credit as asset dissipation to qualify. Wow. And we do this all the time. And literally, these seniors will walk in to their local bank and they want a line of credit or a mortgage, and they're on $1,000 or $1,500 a month Social Security. And the banker's looking at them going, they can't even pay attention at the end of the month. They've got nothing. All right? And they shouldn't make them a loan with a payment. They can't make it. And we close them like that all the time because of the creativity that the loan has. Loan options, fixed versus ARMs. Most of 95% of the loans out there done right now are on ARMs. A fixed is usually your one-shot deal. You could do it on a purchase or a refinance and just eliminate the payment. All of your line of credit options and income streams are HELOCs or ARMs. And it's very interesting when I'm talking to these seniors and they go, oh, I don't like ARMs and adjustable rates. And I'm like, well, why? And they're like, well, my rate could go up. And I'm like, yeah. And they're like, well, if my rate goes up, my payment goes up. And I'm like, you don't have a payment. Oh, yeah, never mind. Okay, the paradigm has completely changed. The only thing the interest rate affects is the balance of the loan at the end. I tell people, if we set this up right, by the time the loan's due and payable, you shouldn't care. You're dead. You know, and the key there is just an exit strategy for the heirs. Typically, they're going to sell the house, pay off the loan, and the remaining equity is going to go to the heirs. The key here is just having an exit strategy and understanding the plan. There are a lot of different financial strategies that can be used. Everybody knows that if you defer your Social Security out from 62 to age 70, you get an 8% raise a year, right? Why not set this loan up, help you along so you can defer your Social Security as long as you can? Let's set up the line of credit, draw the money out, and buy a second home or investment property with it. I have agents do this all the time. It doesn't do you any good to have a paid off house. Set up that line of credit and use the equity to buy a duplex or a fourplex or an investment property. We don't hold a payment against you for the loan. And the property will cash flow or you wouldn't be buying it. And so it's a great way to leverage the equity in the property in order to be able to use other investments, especially on the real estate side. Gifting. I mentioned about gifting the money all at once, but why not set that line of credit up? You know, this old paradigm, back in the 1930s that you bought the property, you farmed it, you worked it, and then when you passed away, you passed it down to the next generation. Well, when you were a farmer, it works. The vast majority of the time now, the kids don't even live in the same state, and the last thing in the world they want is their parents' house. I had an agent refer me her parents a while back, and she said, Curtis, give my parents the bad news. I don't want their house, and I'll never live in Pocatello again. That paradigm is broken and outdated, all right? Set the line of credit up, but you can gift them the money when they need it. Gift it to the kids so they can buy a house with it. Gift it to the grandkids for college. This is how I'm going to help Noah out. I'm going to set the line of credit up, let it grow, and I can control how he spends it so he doesn't buy beer with it. It works. The second home and investment property situation is very significant for the right clients to be able to buy other properties with it. So I want to give you an example of one that I closed with the impact that this loan can have on families. I taught a class in Sun Valley a few years ago, and a few months later I got a phone call from an agent who was in class, and she says, Curtis, you've got to help us. We're on the verge of a family crisis. My mother-in-law has run out of money to make her mortgage payments, and she says if we have to sell her house, she's moving in with us. That's a crisis, all right? This poor widow's house was worth $800,000. She owed $115,000 on it. Her total Social Security income was $1,300 a month. Her mortgage payment is $1,600 a month. She's completely upside down, and she spent all her IRAs, all her 401ks, and all of her Social Security making mortgage payments on a loan she would never live long enough to pay off, and went completely broke before she went to the family for help. This lady had nearly $700,000 in equity in her property, and it sucked her completely dry. Unfortunately, mortgages and real estate, it doesn't matter how much equity you've got in a property. If you've got a mortgage on it, it sucks you dry every single month, no matter how much equity you have. And it's the only investment that does that. All right? So this lady has a $1,600 a month mortgage payment. Her principal and interest payment was $1,000 a month. So of course, I do a refinance. I pay off her current loan. And she saved $1,000 a month because her payment went away. All right? In addition to that, I set her up on a 10-year payment, TENURE, a lifetime monthly income stream that was another $1,300 a month. And we put $50,000 in her bank account at closing.
Jeez.
Family crisis averted. And all we did was re-amortize and pay off her current loan and monetize some of the equity in the only asset she had left so she could use it in a proper, fiscally prudent way. And we estimated, based on her normal life expectancy, maybe there's going to be a $500,000 balance on a house that's worth well over $1 million. And when she passes away, the exit strategy is already clear. Her daughter-in-law, they'll sell the house and pay off the loan, and the remaining equity will go to the heirs. In the meantime, she can live there happily ever after for the rest of her life, and she will never have to worry about money again. And so I took her $1,300 a month Social Security and doubled it. Tax-free money. Took $1,000 a month out of her budget and put $50,000 in her bank account at closing. Family crisis averted. This is the kind of impact that this loan can have for families when properly used. And very privately, the daughter-in-law and the mother-in-law both said they would happily spend $500,000 to not live together. Best investment they ever made. The myths. There's more misinformation about this loan than all the rest of the loan products put out there altogether. The first one, people think, oh my gosh, I'm signing over my house, my title, and my equity to the bank. Never, ever been true. You buy the house, the customer's put on title, the lender puts a lien on it. Done. The vesting works with this loan just like any other loan, and they can sell the house and or pay off the loan and keep the equity anytime they want. All right? I have people say, they just know that there isn't going to be equity left in this. It's just an equity split. We're going to use about half the equity in the property so you don't have a payment, and we're going to leave the other half for the heirs. FHA is very good at these amortization schedules, by the way. They've had enough time to be able to track it. The last thing they want is a property that ends up upside down. Okay, so they're very good at these amortization schedules based on age to be able to figure out exactly what that down payment needs to be. That you can outlive the loan. It says in the promissory note, due and payable on your 150th birthday. Good luck. So you literally can buy a house for 50 to 60% down and live in it for 20 to 30 years and never have a payment. You cannot outlive it. We'll talk about this on the refinance side, but anything you draw out of it with this loan isn't a taxable event. doesn't affect Social Security and Medicare, that borrowers can be forced to leave their home. I have people say, well, but I don't want to lose my house. And I'm like, how does a lender force somebody to leave? Payment default? Guess what we don't have? Payments. You have to pay your property taxes, your homeowner's insurance, and live in the house 6 months in 1 day. There's nothing in the note about mortgage payments till death. All right? There aren't any. It's actually an excellent way to protect the asset, and it improves the chances of seniors being able to stay in their home because it leaves them with additional liquidity, and they're not making mortgage payments until they go broke and die, which is the alternative that many of them have. But what about my kids? I'm like, really? They're 50. At what point in time does it get to be about the parents again? 65, 75, 85? People think this is an all or nothing. This is just an equity split. We're going to use part of the equity so we don't have a payment, and we're going to leave the other part to them. People think this is an all or nothing, and I sit down with a customer and I say, if you have a retirement account and you use half of it in your retirement and you pass away and you leave the other half for them, is that fair? And they go, well, that's fair. We just split it. This is no different. It's not an all or nothing. It is just a share. And we close these loans in trusts all the time. So it's a trust-friendly loan as well. Final questions today. Purchase, refinance, income streams. Sir.
Where did this lady right here come up with 50 or 60%? She was totally out of money.
It's equity in the property. It's a refinance. The house was worth $800,000. She only owed $115,000. The loan to value on it was right at 50%. So it was a refinance, and we just monetized the equity in the property. Other questions? All right, so just a couple of things. Keep in mind this is a CE class. You will get 2 credits for it. You should see those. They'll get loaded with IREC, and you should see a CE certificate within the next week. If not, reach out to me or to Title I. Don't forget, I have videos on this. I have an 8-minute purchase video, an 8-minute refinance video, and a video of the actual class. Feel free to reach out for those to Kevin and I. And like, as I said, to forward that 8-minute video on might just be a life-changing event for somebody that watches it. Class is officially over. I would like to share, however, that we do have to close some home loans to support our teaching habit. You never know who you know. Okay? We don't charge for phone time. Everybody knows somebody out there that this loan can help. There are baby boomers out there by the millions who are scared, broke, in a 30-year loan that they will never pay off, where this loan can help them live a more comfortable, satisfying retirement if we can spend a few minutes and they'll be open-minded enough to be able to engage and look at the concept. I appreciate your time this morning. I know how important and valuable your time is. Class dismissed. Thank you very much.